Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, January 30th, 2025. It is 10:49 a.m. Eastern Time as I'm starting the video. I'm going to start out with the equity markets. I'm going to talk a little bit about that VIX trade I threw out to you today. Just kind of trading opportunities, trading strategies, how I see things right now and where the opportunities might be. Like I said in that post today, I think I covered everything I need to say about the VIX trade. I trade the VIX very judiciously. You can't go in and out all the time. You can short it, and for the most part, 99% of the time, you want to be short the VIX, especially the VIX ETFs. I'm going to speak to that real quick. But let me get to that when I get to the VIX. Let me cover the indexes, show you what I'm watching. Again, it's kind of a reiteration of what I threw out there this morning. This is the current uptrend line I'm watching on ES. I'll show you again why I'm using these 15-minute charts right now. We've had some volatility lately, and again, you have I can pick up a lot more nuances in the charts, reactions, looking at the futures. Not only am I a futures trader, but I also, I do trade ETFs in different accounts. But again, the futures have those round-the-clock trades. You have a lot more candles. Therefore, I can pick up on trend lines and horizontal price and resistance levels that you may not see on QQQ or SPY or IWM, whatever you're trading. So again, I know a lot of you prefer ETFs, don't trade futures. You can do your best to replicate these trend lines. Obviously, I do cover. I haven't given up on the charts. And we'll get to the 60-minute and 120. Daily charts and weekly charts, and we'll even look at those here of the ETFs. But right now, this is a level I'm looking at. As I made clear today in the post I got out to you, one reason I will almost always include the S&P 500 along with the NASDAQ 100, even if I'm only trading one or the other, it's because they are the large cap indexes. QQQ or the NASDAQ 100 is just a higher concentration, higher weighting of the same tech stocks. Remember, the S&P 500 by far, it's double the next largest sector. There's 11 sectors in the S&P. Tech is by far the largest at about a quarter weighting, and it's just about over about a 50% weighting in the NASDAQ 100. So they're both, tech is the largest component of both, largest sector in both. The same top holdings, Apple, Microsoft, Nvidia, the usual suspects, are also the top weighted in the S&P 500. They just have a lesser weighting on the overall index, because in the S&P 500, of course, you have 500 companies. In the NASDAQ 100, you have 100. So, all right, let me just get into the charts here. So this is the level I'm looking at, and obviously, if I have down arrows, when I draw the dashed arrows with the slightly dehighlighted or whatever you call it, less bright lines, the dimmer arrows, those are alternative scenarios, but they both have you going to the same place. Again, a marginal new high, we're talking percent or so or less. To me, the arrows all go down. Now, with that being said, one thing about the only guarantee I'll ever give you in trading and with my analysis is that I will be wrong, and I'll be wrong a lot, and that's what stops are for. So if we power on through here, if Apple happens to, or the market likes whatever reason, whether it's Apple or not, Apple's probably going to be the last and final catalyst this week of determining which way the next big direction we go in. And I'm going to get to Apple here in just a second. But yeah, if we pop those highs, if we take out, what does taking out the divergence mean? Well, when you start taking out the previous highs, you no longer have negative divergence. Now, as I said this morning in that post, should we go to a new high anytime soon, as long as it's just a marginal, meaning relatively slight over the previous high. Relative is to the time frame you're looking at. But as I stated, 60-minute. Here's the well. Let me show you. Let me get to the 60-minute charts. Let me go to NQ here. So this is the NQ chart I got out to you this morning. There's the big gaps from Sunday evening. Gaps in the futures, especially big gaps, are pretty unusual. If they're going to happen, they're going to happen usually on Sunday night, because remember, the futures will trade around the clock, except a 1 hour shutdown period every day from 5 to 6 Eastern PM. They trade around the clock, but then they shut down Friday evening and they pick back up Sunday, and that's where we had the gap down. and they just didn't let the longs out or the short sellers in. That big plunge, that was the deep seek AI news. Call it what you want, but we were already short because we were coming off. Remember, we had on the NQ. Oh, that's a 15-minute chart. Here's my 60-minute chart. Remember, we had this divergent high, and we had that sell signal there. We ended that divergent low. We went long there, rallied up, and then I highlighted this as my maximum bounce target off that divergent low, and that's exactly what we hit. So I highlighted, that would max target is that's it. I'm going any further, I'm just wrong. That's beyond the bounce, and that was a perfect re-entry there, add-on, and that's where we're at now. So then, you take it down shorter term. You can even see it here on the 60-minute chart, but it's why I'm living in the world of those 15-minute charts, because we have this volatility right now. We're in a mostly pretty much a big sideways range. And when you get that, as I've stated for actually months now, going back into November, I've switched into active trading mode, especially my primary trading account, and just swinging these rips and dips. Because as an investor, as a trend trader, or even a typical swing trader that measures their holding periods in many weeks to months, you've gone absolutely nowhere now for months. As an active trader, this market has just been, printing money. Again, if you step down to those charts. And at some point, I morph back into swing trend trading, and that's going to be most likely when and Apple may do it for us here. We'll probably not. Probably won't know till next week. But if we take that recent low out, this is a big low. A lot of traders are going to be watching it. It's where we had that plunge in the futures on Sunday evening down into Monday morning. It's where reaction low there. That's kind of, in my opinion, most likely lights out for the market. Let's not forget, if that happens, if we take that out, that means the Nasdaq's going to drop from where we are now, roughly. I'm just going to ballpark it. We're going to drop almost, about 5%. Okay, so let's talk on that. And right now, we have what I call the charts being stacked. I make a lot of terms up. This is one of them. What I mean by the charts are stacked, well, when you go to the different time frames, 60-minute chart, here's my 60 right here. Remember, this was a divergent high. As I stated, any marginal new high anytime soon will still be a divergent high if it happens soon. If it does that and then reverses, you can see down here, there's no chance of the divergence being taken out unless we go up a lot more. So, punch up through there, 10% plus new highs. Yeah, you're going to take the divergence out on the 60-minute chart. However, you're also going to have it here on the daily chart. Let me try to, we'll zoom in here. So this was a divergent high. Any marginal new high as well will be still a divergent high. And even if we go out to the weekly chart, the all-powerful, these are really, the weekly charts formulate the bigger picture, where we're likely going, how far the next trend is going to be. And I've maintained for quite some time now, where's the weekly chart? I've maintained these targets down here, which calls for about a 50% drop in the NASDAQ 100. And it's still just a continuation of last year. We went down, we hit my first and second target. We bounced. That was the day, the August 5th lows. I made an unambiguous post. I'm covering all shorts going to a hard long, not easing in, it was a hard reversal, because everything I was watching, all the big stocks, the indexes, they were all hitting the 200-day moving averages after a big drop down to them. It's not like they've been limping on them. Support, everything else. So this is just the bounce reaction, if you will, off my second target. And so we go down. We already hit T1 and T2, so I don't expect a lot. Doesn't mean we can't have a reaction or a bounce. Doesn't mean that we can't go back to T2 and then new highs. To me, what it means is the odds say we're probably going to go down. And what I've been saying for a long time, I think we'll probably just have very little reaction. Might punch through my T3 and hit T4. So this is really kind of my next swing like to see at this point in time, if the charts tell me to cover some swing and trend shorts. But where I was going a minute ago is, if we punch down below the recent lows, I'm not going to be as interested in gaming counter trend bounces, long side bounces on 5-minute divergence or 5-minute pullbacks to support on the 5 or 15-minute charts. Because if my read on the chart is correct, on the charts that is, those, if we break the recent lows that I just highlighted, those minor support levels on the 5, 15-minute charts, the divergences, oversold conditions, they just get sliced right through. That's, again, kind of my read on the charts. And so I just want to let you know that's where I'm no longer interested in gaming little 2-3% bounces back and forth. That works great in a trading range, but you need to recognize and in my opinion, anticipate when those trading ranges are going to end. And so all I can tell you right now, you can see it here. This is the recent trading range right there. And that's that level. Take that out. Boom. And then we go down lower. All right. And then as I stated, monthly chart. This is the monthly chart of QQQ. I can't speak to other people. I don't follow anyone else's analysis. I'm kind of do my own thing in a vacuum. I like it that way. I don't want to be influenced by others. I have my own style. But I imagine very few pay much attention to these monthly charts. But what I can tell you is QQQ, this is your primary trend line off the early 2023 lows, one that I've harped on quite a bit. A lot of key stocks have support there. That's when I went all out bullish in the beginning of 2023 with my 2 top picks being Amazon, Apple, and expected the NASDAQ 100 to outperform the S&P, which it most certainly did. I didn't realize it would go this high at that time, but either way, that's where we're at. And we have a beautiful uptrend line in which to trigger a beautiful sell signal. Anywho, and you can see the big divergence. And so if you wonder how can Kramer and everyone on TV is telling us it's going to be a good year in 2025, the consumer's holding up, there's no risk, credit spreads are low, blah, blah, blah. How you can even think that the market's going to drop 50% or even 30%. Again, this tells me that's the most likely scenario. And you can see this yellow uptrend line. That's an uptrend line off the '09 lows. So what we've been in, you can call, it's semantics really, whether you want to call this a bear market. It met the old school definition. Same with that 31% drop, 24 there, 26 there in QQQ. Remember, QQQ is an ETF, so there were flash crashes that took it down more than the actual index itself. But even then, COVID, 31. Just to get to this trend line. And so where I was going is this has just been one supersized, one of probably the biggest in history, supersized bull market a la the Fed and all the central banks with unprecedented, almost unfathomable market manipulation with excessive monetary and fiscal stimulus. Fiscal from the Fed. I'm sorry, monetary from the Fed, fiscal from the federal government, but the Fed keeping rates, as we all know, near zero, at or near zero, all since the financial crisis. They tried to get away from it a couple times. The market bulked back in Q4 2018 when the Fed tried to hike rates in, as I predicted, threw a little tissy fit, and boom, Fed gave them back the screaming baby, what it wanted, and that's where we're at. And so those excesses there will be a price to pay. And that's where some, in very large part, but not all, where my longer term targets come from. They come from both fundamental and technical analysis, just to get to the bull market trend line. If you're just looking for a correction and you're thinking the 50% target's too aggressive, that's a beautiful uptrend line that comes off, again, the 2009 lows with a lot of clean, distinct reactions. So that would obviously be a level that I would be interested in, and it probably aligns with some of my other price targets I showed you. Yeah, it does on the other charts. So, so that's it. If you want to kind of know big picture right now where I think we're going in 2025, and we got to get the sell signal. Remember, everything I do when I show you a bullish setup or a bearish setup, I have price targets, and if you take anything from this video, take what I'm saying here. I've said this many times in the past. They may sound the same, but there's a ginormous difference between what I call a trade setup and an actionable trade. A trade setup is a trade pending a buy or sell signal, an entry point. And if that entry trigger never happens, it was never an actionable trade. Now, we're short, and we have been Qs for other reasons, been in and out recently from a long-term perspective. In other words, let's just say you're a 401k investor. Your sell signal here is going to be, this is a monthly chart. Now, a lot can happen and will happen when this breaks down. In 1 month, it'll probably be a big red candle, but you want to see a solid red candlestick, and you have to wait. If you're trading on the monthly time frame, if you want to avoid whipsaws like this one, then you wait for monthly close. And when that happens, the trend has changed, and it'll increase the odds that we're going to go down and hit that minimum target, which is simply a correction back to the secular bull market uptrend line, right? And then if that goes, it's going to get ugly. Let's just, first things first, like I said, that's that one. That line's about roughly, again, depending on when it breaks down and how we get there. What I mean by that is if you go straight down, which you're not going to probably do, straight down from where we are, as I measure, let's say we hit it next month, it's going to be a 26 or almost 27% drop. But let's just say we go up further and then we break it over here. Again, it all depends on the rate of descent, assuming we get a breakdown. Do we do that or do we do that? That's going to be a lower drop in percentage terms. All right, let's talk the markets. This is very important to kind of where we're at right now from a technical junction. We're going to go to the big market leading stocks. I'm going to talk a lot about Apple. I'm going to loop back to Apple, but remember, I put a big weighting on these 200-day moving averages. They're not the be-all, end-all, but they're about as good as it gets because everybody uses them. Like I said, computer programs will buy when things pull back to the 200. Humans will buy. I have little doubt those that are managing Apple's stock buyback program fired off the buys when it hit there. That's what I would if they put me in charge. And I highlighted. So these are the 200-day moving averages just on my weekly chart, shown as a 40-period weekly. What's 200-day? So we have Apple there. Let's just go through this real quick. Microsoft, and I covered this in detail yesterday, so I'm not going to do it again. We had two different Mag 7, Mag 8 stocks that did the same thing before the 2002 bear market or 2022 bear market that started right in the beginning of 2022. Technically it was in November or October. That's when the NASDAQ peaked, and then the S&P followed in January, first trading day of the year, started going down. And Microsoft, like I said, has been hugging the 200 days. It won't give them up because the rest of the big market leading fangs are well above them right now. And so people are going to come in and buy. And remember, when you have the index is either rising or at least holding up, you have inflows. These stocks are so indexed so heavily together. And so many people, myself included, trade the index ETFs, whether it's QQQ or NQ, the futures. And so money going in and out of the futures proportionally goes in and out of each of these stocks due to their weighting in the index, their market cap weighted. So that's one reason Microsoft hasn't given up the ghost, but it's not going up. It's just holding those lines, the 200s. And remember, they just reported they're down today. If you're saying, well, Randy, looks like they're below both. No. You want to see a clear, it's okay once in a while to punch through there. Remember, that was August 5th lows. I addressed that at the time. Several of the market leading stocks did undercut the 200s, but most fell to and hit those and or comparable trend lines. Hence the reason why you had that brief overshoot there. Either way, Microsoft is right there. NVIDIA is right there as well. Starting to crack, but again, not clearly below it. And so there's Amazon, plenty of room to go. Alphabet, plenty of room to go. Meta, comfortably above. So it's almost identical to what we had in the going into the end of 2021, early 2022, with two of the Mag 7 already sitting on, ready to break the 200 days, and the rest not yet doing it. And then the others came down pretty quick from there once they cracked. So where I'm going, and maybe I'm overdoing this, I don't think so. It's something to watch. That's all I point out in my analysis, are levels to watch. Apple has, there's a line right there. Yeah, these are targets I gave you. We hit T1 right there, and that was the first target. Hit it again. We had it back here. I gave you a setup there. We hit it again, and we hit it with the 200. So this is still the next target, third target, fourth target. Actually, you can see T3 was back there, the 207 level and or the 200-day moving averages. But so that's what we hit here. So effectively, that's a T3 hit. All right, but let me go back to this chart right here. I do see a level, and I had it there. I want to add. That's really nice support. You have these reaction lows, reactions there, reaction high right there, big old gap, top of a gap. And the 200s. This is such a big level for Apple right here. I can't even stress the importance of this level. Now, Apple can go up if they beat tonight, and then we rally tomorrow into next week. Your first pretty good resistance level is that trend line. So a back test of the uptrend line, that would be about a 4 or 5%, depending if and when we get there. Now, on the downside, how much does Apple have to crap out tonight? Well, an 8% drop, give or take from where we're at right now, would take us right to that support level and back to the 200s. It wouldn't be a good thing to see this whole thing faded, I can tell you that. So let's just keep it simple. Anything much more than 8% is going to undercut that level, open the door to some powerful selling. And as long as Apple can hold above there, if it pulls back and tests it again, that's it. I'm giving you the levels to watch. This is resistance. We're at right now, 237.50. Previous all-time high, double test, breakout, and it failed that breakout. So this whole thing right now is a failed breakout to new all-time highs. And all we're doing is back testing that level. So we're at a very critical juncture as we go into report. So watch this one. And when I go to the longer term charts on Apple, which we're going to do right now, remember we're below this trend line. That's the April lows right there. Nice, well-defined trend line. We had a sell signal there, breakdown. There's the trend line I told you we could back test. That's a level that would be bearish if taken out. There's a monthly chart on Apple. This goes way back to the 2003 lows. This is what we call a secular bull market uptrend line. So you have two types of bull and bear markets. Secular, which is a larger, bigger picture. In other words, I've showed you Treasury bonds, how yields, interest rates on the 10 and 30-year bond have fallen since the beginning, since 1980, really. So that's a 45-year secular bear trend, although that ended and we're in a new, what I believe, secular bull trend in rates. I've made that case. And this is what we call a secular bull market right here. And there's your secular bull market uptrend line with plenty of cyclical bear markets within there. 42% drop, 62, 45, 34, 39. I didn't update it here. It said, see my only, 29%, meaning unlikely, probably a bigger drop to come. And so this is where, if that breaks, you have to understand the technical significance. It won't just be another correction. There's a good chance we're going to begin a new secular bear market in Apple. And this would be a likely target. It's absolute heresy. I'll bet you there's not a person in the world out there right now, very few, that think Apple can drop 75%. This is Apple, of course, we're talking about here, and they are an earnings juggernaut. Just remember, no dynasty, no reign goes on forever. And I'm not even going to speculate on what will be the ultimate demise of Apple, but it's just when I look at the chart, it's what I see. Now, we haven't broken that trend line. This is a monthly chart, and also this blue line here does a great job of defining bull and bear trends on the stock market. It's the 20-month exponential moving average. If you roll back here, here's the S&P 500. Look at that blue dotted line. This was doesn't look like a lot, but that was a big double-digit drop bear market. But in a bull trend, you want to buy pullbacks to it, and it defines a bull trend. Once you break it, these were your true bear markets in recent years. 2000, the dot-com bubble into the '02 lows, and you can see how beautifully this 20-month moving average defined the bear market. And once you took it back, you were in a bull market. Not only that, you just kept buying pullbacks to it, and that just juiced up your returns. And then when you took it out, you back tested. I don't know if you can see that in the video. I sometimes zoom in. I need to zoom in for you. There was the breakdown candle. We were below it. That was the '08 bear. In the beginning of late '07, we topped. We went down early '08, had a counter trend rally, perfect back test, and rejected, and it kept that bear market going. And so, back then, hey, you traded this in your 401k, you would have got out there. And if you were a short seller, you would have shorted on that put bounce back there. Or if you missed it in your 401k, you were a non-believer at the time. That would have given you another objective entry to get out of equities right there when you back tested the 200, and then get back in when you took it back. And nothing's perfect. Couple whipsaws, but even if you followed it religiously and waited for a monthly close below it, and then the first monthly close you had back above it, it put you right back in, and it kept you long and strong. COVID got you out, but the very next month it put you right back in, and that's it. So 2022 bear market, it got you out through at least half of it and put you back in here, and we're above it. So that's a level. We're not really, I'm just throwing this out there today, but I do this as I do all my analysis. I try to get these levels out to you in advance, and the one thing I always warn about, and I mean, if you, again, take anything to heart as well, take this. Stocks tend to fall a lot faster than they rise, especially when a lot of conditions are present. Those conditions are present now. They've been present for a while. I've been talking about them. And they may or may not manifest in the form of a very swift, powerful drop like we had here, It doesn't show as well in the S&P. It shows well in the NASDAQ back in 2000. So my point is, be flexible, Red. Even if you're bullish and you don't want to hear any more of this bear speak, just stay flexible and just be open to not the possibility. Anything's possible. The probability, which is up there right now, that we can have a very swift drop and cut right down in very short order. I always say be on guard. I use that analogy heading into Christmas. Remember back in November, I talked about, the Tet Offensive, considered the most successful military campaign against the U.S. in the Vietnam War. And I said, everyone's talking about a Christmas rally. Everybody was talking. They weren't, in the media, they weren't talking about whether we were going to get one. They were talking about how big it was going to be. I mean, this is me reading the headlines. America's, perma bear de jour, Tom Lee said, get in, it's going to be a powerful Santa Claus rally, and it didn't come. And so I said, even though that's historically what's expected, the charts at the time, we were looking at, didn't say we were going to get one, said we were going to go down, and we did. We had a weak December. Santa rally never came. And so, in other words, just be prepared and take that seasonality stuff and what they're telling you on in the media with a grain of salt. Let the technicals, let the charts be your guide. Ultimately, is what I'm trying to say. And again, when you look at this big picture here, another thing to look for. I've used this many times. This is the S&P. We can do it with the NASDAQ as well. These bearish PPO crossovers. I think you can see it here. Let me turn the histogram up, make it a little brighter. And, we haven't crossed yet. There's a way to go, but if we fall quickly, we could make a bearish crossover. And when you do, you can see there's our last bearish crossover. We had one right there. We had one right there. It came, and then a little whipsaw, and then it crossed again right there. So all these big drops were foreshadowed by these bearish PPO crossovers, the bear markets and the big corrections, right? So watch for that. Again, we're not at risk this week of that happening, but and this is why I talk about the charts being stacked. I know I went off on a lot of tangents earlier in the video. I showed you the 60-minute charts, even the 15-minute charts, and the level that I said would probably be lights out. So if that goes and we fall quick, we can, by the end of, as soon as the end of next week, it's not going to happen this week, potentially, get a bearish PPO crossover there, and also take out this primary uptrend line here on QQQ and SPY, the trend lines right there. And then boom, it would be most likely a quick swoon down. Maybe the 200 20-month comes into play again, but if not, this is your This is your primary bull market uptrend line on QQQ. Let me measure that for you. That's going to be about a 25% drop to get there. Again, this is the trend line off the late 08. Everything else bottomed in March of 09 except the NASDAQ. It actually, the tech-heavy NASDAQ bottomed technically in November of 08. Remember that. You can see it if you look closely on the charts. But this we'll call it the late 08, early 09 bottom. And it's just a beautiful uptrend line. And it's a magnet for the next, drop. And again, we'll probably have a reaction on again. But whether we do or don't, when that trend line goes, then you need to really start thinking about your long-term, 401k type money and other stuff, because that is a beautiful, well-defined cyclical bull market trend line. And this massive divergence, which is rare on the monthly chart, tells me that it's likely to ultimately break. Okay, that's it. I don't want to beat a dead horse. You have the levels to watch, both near-term and long-term. And again, understand that the charts are stacked. So if we do get those sell signals on the shorter-term time frames, they have the potential to then inflict technical damage, or i.e. breakdowns, on the more significant daily, weekly, and potentially even the monthly charts here. All right, so this is what Apple looks like. And I already covered that long-term chart. Let me give you some other things. Okay, so on a related note, we'll talk about the VIX. VIXY is one of many VIX tracking ETNs. Remember, you and I can't, and nobody can trade the VIX Volatility Index. All you can do is trade derivatives on it. And those derivatives are futures, options on those futures, or ETNs and ETFs that track those futures, such as VIXY. Over time, you will lose money. This is a hit and run instrument. Let me repeat, this is a hit and run instrument. The only strategy long term on this thing is to short it if you can get the shares from your broker and not carry too much in interest, because over time it will decay, because this is not the VIX itself. It's doing its best to roll the futures, but there's a lot of expenses and fees. This is the VIX Volatility Index right here. And the VIX doesn't go down over time. It has a floor. And the thing is recognizing these floors, and also it's really looking at the stock market upside down. By that I mean, while we have the big negative divergences I've showed you on the weekly and even daily and even monthly time frames, likewise, we're coming off a positive divergence on the VIX, because the VIX goes up when the stock market goes down. So it makes sense. They usually are inverse mirrors of each other. So there's that divergent low back then. The VIX, this was in 2000. That was the bear market from late 07, October of 07. I'm going to try to measure it. If I grab right on it, well, I can do it this way. I can turn everything off, grab it. And that bear market, the VIX peaked in mid-October, even though the stock market, and remember, this is the VIX. The VIX doesn't track the NASDAQ. It tracks the S&P 500, which bottomed in March of 09, early March. But the VIX, and I've said this many times, and we've successfully sidestepped huge givebacks and booked some profits on the VIX trades I've shared, because from my experience, the VIX will peak first, then the market bottoms during corrections of bear markets. So I usually will close out my VIX longs before I close out my index shorts. That was a 900 and almost 1,000% rally in the VIX. You can look at the rest of them there. All I can tell you is these are the big corrections in the bull and bear markets. Divergent low, divergent low, divergent low there, and this divergent low. That was that last one I got out to you this morning. I showed you the trade we had last year, which I'll get to here in a second. And just wanted to mention that this is where, since 2000, the great bear in 07 through 09, this is where bear markets end. There was COVID right there. So the two biggest drops we had, the S&P dropped 36% during COVID right here, and it dropped 55% in the 08-09 bear, and that's where bear markets end. And so that's why this thing we had in 2022 I view as kind of a shot across the bow. It's where corrections, this is my level ever since the 2008, 07 to 09 bear market. This is where corrections ended. And that was a correction in 2022. So the next bear market's probably going to take us up quite a bit higher. And that's also kind of meshes with my pretty deep downside targets on there. All right, let's look at VIXY again. And again, this is a trade. Pass if it's not your cup of tea. It's about as aggressive as you can get. Sure, there are leverage ETFs out there and ETNs for the VIX. You don't need them. It's like, going and buying a, $500,000 Ferrari and then taking it to your mechanic and having putting nitrous oxide in it. The damn car's fast enough. You don't need it. The VIX will go up and down easily 20-30% in a day and then do it again the next day. So I like the futures. That's what I trade. But if you're going to use these ETFs, that's why I'm sharing this one. It's non-leverage. You don't need the leverage. My price target, should it be hit right now, my maximum target would be 165% rally, right? This was the entry right there. I didn't, in the chart today, I didn't show you, but it was literally the day before, and that was a wedge. I added that wedge line. Again, I gave you that previous chart. So we went long right there. I had a total of 4 targets. We exited early, but that was exactly where, right there on these lines, was where my third target was. What I was trying to explain in that is the VIXY over time will continue to reverse split because it's always going to lose value. The last time was a 1-to-4 reverse split because it has those fees and expenses it's losing by continually rolling futures on something that really isn't going up over time. It just spikes up. The VIX, think of it like an EKG. And so that's it. We're just trying to catch that next blip. My strategy was a partial position here with an add-on on a breakout above the trend line, first, second, third targets. Obviously, if it starts to play out, I'll may fine-tune these targets based on the actual spot VIX and or the VIX futures. So that's it. And again, if it's not your cup of tea, you want an intermediate term target, let me add one right now. If we start to spike, that's not the line I wanted. I'm going to give you one more initial target right here. I see resistance I should have had at 50.26. In fact, I'm going to leave. I'm going to make that S1. Technically S1, meaning first supports the downtrend line. This would be really S2, if you will. So let me make it that. Too shallow a target. I mean, it would be a nice lift from here. If we hit it, it's going to be a 21% rally. But if we pop the trend line, that's really what I call the benefit of the doubt resistance. It's pretty nice resistance, and it should open the door to a run, a quick move up to T1. T1 gets taken out, T2, etc., so forth and so on. And like any trade, especially this one, don't put too much in it. Take your position size down. You don't need to put a lot of money in it to make a lot. If it goes up there, even if it just goes to the second target, you're talking almost a 90% return. So likewise, if I'm wrong and this market's going to pop to new highs, especially after Apple, VIX is probably going to go down. And then, as I showed you, going back to, what I love about this trade, guys, and any trade, is the RR, the risk-reward ratio. You're risking. If the VIX comes down, you can see this is a daily chart. I know it's busy, but you can see this is a massive support zone down here. I have in blue support. This is long term. This is about as low as a VIX gets to, especially in recent years. So to try to quantify it, we're at 16 right now. So you're talking about, and it's not little, but it's about 27 to 31% downside there. Whereas on that VIXY target, my upside target is about 170. See how it works out? It's the RR, and that's why it's all about taking trades with a favorable risk-reward ratio. Now, you probably don't want to hold out for a 30% downside. We could go down a little bit more. Maybe Apple pops afterwards, and then we set up this bullish falling wedge. We go down a little. So where your stops are going to be depending on your take on the market, obviously. You only want to trade the VIX when either you have a high degree of confidence the stock market's going to correct, or in this case, kind of a combo with the two, the risk reward is worth it. You might be, say, okay, you know what, I'll take this. I'll give myself a 10, 15% top, 20% stop loss. And if a 20% stop loss sounds high to you, remember, you're going to take, at most maybe a quarter of the same size position you might take in SPY or QQQ. So therefore, a 20% loss is comparable to only a 5% stop loss being hit on a SPY or QQQ trade. because remember, it's all about the dollars you make or lose, not percentage. To me, is you don't get tied up in that. Again, frame it in risk reward, and then take those higher profit, higher loss potential trades and adjust your position size down accordingly. Because what's going to make you rich or broke is not what you make or lose in percentage terms, is what you make or lose in dollar terms, hard dollars. Okay, let's hit on the other stuff. I already threw out a GDX chart to you today. That one was pretty clear. We took that right here, boom, right on that support zone right there. That was my initial sold target. That day in a video, I added this intermediate target, resequenced them to, that was formerly T1, so I made it T2. That was a new T1, so we'll probably get a pullback, and then we pulled back right to that S1 like I highlighted would be an objective entry. And so boom, either way. If you're bullish on the metals and miners, you notice I didn't reverse this one, just book profits. It probably will have a reaction here, where to at minimum back to the trend line right here. I might tweak that trend. No, leave it there. So this is probably a momentum fueled overshoot. If it breaks the trend line, we're probably going to go down quite a bit more. I don't have a high enough degree of confidence to short it right now. I might soon. Depends on what gold does, what silver does. Gold's putting in now. Extended the big divergence that's been building for a while, but again, divergence is not a sell signal. It's merely an indication. This is these are the trend lines to watch on gold. That's how my daily chart on gold looks. So you don't want to short the miners or go long until you can make a case to short gold and or go long gold. So there's your update on that. Crude oil working out so well, working out so far, working out. So last week I highlighted it here as a long entry. I had this downtrend line I've just ever so slightly tweaked. I wanted to come in and capture those. I kept it at the same point, but I moved it up just a little bit, and we're here now. So I highlighted there. We rallied up, hit the trend line at the time was there. So nice bounce trade, recycled back in, back to the support. I highlighted it yesterday, threw it out, even gave you a hard chart on it, I believe. And now we're at the downtrend line. With that positive divergence still very much intact. So it's simple. You're already up. I don't know what you're up. Was since yesterday? We about 2% or so. But if we can pop that trend line, that should open the door. This first target's a little fuzzy. It's where I have the line. Might be prudent to put a little lower. This is still a nice target up there, 76.20. Just kind of taking it step by step, minute by minute. But as long as it remains above there, it's still I mean, the buy was yesterday. I wouldn't buy it here. You just rallied it to downtrend line resistance. Now the only trade is to take profits on the long. If you took it yesterday, get the quick buck, recycle back in, or wait for a breakout to add to it. Just go over the rest. Natural gas is sucking wind. It's still, it has the divergence on the 60-minute chart. But remember, it had that negative divergence that continues to play out. I need to see a little more there. I posted this morning. If you didn't get it, I always encourage you to go in and check the site for updates. And I mentioned this morning right here that I took out. I'll go over TLT in a second here. I closed out half of my ZB trade. I'll show you the reasons why. So I just want to let you know this morning I did that. And somebody asked me, I saw a question. I hadn't replied to it because I hadn't checked it. This little live button, if you're seeing that, it just does something on the back end. You shouldn't have access to it. Don't worry about it. It doesn't do anything for the site. These are just some things I see as, running the site. So if you see that button, I'll try to make it go away. It doesn't do anything. Let me start with IEF, start with the 10-year bond, because that's the most important bond really to the market. Remember, this goes back, all the way into early last year. Again, if you followed me that long, you know that I had these zones here in relation to what the Treasury bond price is, aka yields. Remember, Treasury bond yields and prices move inversely. So this is IEF, the 10-year, and I gave you these zones where the stock market would start to take note of rising yields. If the bond fell, 10-year bond fell. Orange market, I said the stock market would really start to take note of rising yields. And the red zones where the stock market starts to freak out. We haven't gotten into the red zone since, and that's one reason the stock market's not far off all-time highs. When we get here, you do not want to be long equities, in my opinion. That's going to be quite bearish. Now, we're not there, but what I can tell you is the orange zone all the way back here was there. These levels were tactically placed based on resistance levels and things like that. And so I just wanted to point out we got the bounce. I've been, stoically bullish, treasuries started getting in right here on this divergent low, maintained it all along, still really liked them, pushing the treasury trade, and we got it. We finally broke out of the bearish rising wedges. There's another 60, well, there's the 60-minute chart. Now we're at resistance. Let me see if I can show it to you on a different board. Let me show you the futures. That's really what I've been tracking. Okay, this is a 6-month chart of ZN. And that's it. That's really good resistance. I've been highlighting we still have, and it's extended now. I'm going to do this. This divergence continues to build. Remember, I always say it. Divergence is not a buy or sell signal. It's a condition. We had divergence here and finally started to play out right here. We started to have it here. We had divergence at this low. I believe that's where I started highlighting treasuries. When we went lower, the divergence got even bigger, so I stuck with the trade. I doubled down on it, and then we broke out. Now, so this divergence could get burned through, and these are still potential targets, but there's an uptrend line, and this really, if you look at this, it's forming a wedge, and I'll show you one other thing that prompted me to take profits on half my position, and I might close it all. Again, this is the 10-year right here. Let me just show you real quick the 30-year Z. Okay, this is ZB, the futures for the 30-year bond. There's your uptrend line. This is the divergence that's been building right now. That was a bullish falling wedge, which was a catalyst for this move up, our breakout right there. And we've hit now that, and we still have a potential inverse head and shoulders pattern that could break out. But this is pretty good resistance, and we've been capping here recently. And let me just take it home with one more chart that really was probably the main catalyst why I wanted to lighten up on treasuries and may throw them all away today. Right here, this is TNX. This is the 10-year treasury bond yield. This is significant to me. This is a primary uptrend line, comes off the September lows right there. 1, 2, 3, and now 4 reactions we've been holding here the other day with price support as well. That's that 4.5% yield on the 10-year right there. That was a divergent high. That was a case for us going long and being bullish treasuries, meaning yields fell. We rallied in treasuries, but that's very good resistance. Now, if we break that, yeah, yields are going to drop. Bonds should go up. That could happen if the market craters. We'll get a flight to safety bid. However, support is support until and unless broken. So this was a big reason for me to at least lighten up here. And again, I may just close that trade out soon. It's all about RR. I'd rather not give back profits than risk, leaving money there to risk giving back profits, that is, to try to make a little bit more. So we'll see. I'm just going to kind of keep an eye on this. Wanted to share that with you. And that's about it. I told you the grains still look good after the breather they took. We had the beautiful breakout, big bullish falling wedge right there, divergent low, breakout back test, second back test, rallied. Now we just hit my 569 target on ZW wheat futures. The grains still look good, WAT. And that coincides with that $5 price target on wheat, the ETN. Same thing, breakdown back test, rally right into resistance. So if we pop 503, we're probably headed to 551, then up here, so forth and so on. 60-minute chart, there you go. That's it. All right, let me wrap it up, get the video out to you guys. And again, if you're new to this, and you're somewhat risk averse or don't know what to do, Nothing wrong with just sitting back and waiting. Let's see what the market does after tonight. It's not just Apple. You have quite a few other big companies reporting. And remember, there's been volatility and deterioration in some of the big things. That's how it always starts. It's not all of them at once. Like I've said, Apple's broken down. Microsoft's been hugging the 200s. And that's how it started back in late 2021 before the big drop. So, caution to be warranted. We could still punch and go to new highs. Hell, we could have a blow off top this year. I'm open to anything. I'll let the charts be my guide on that. But right now, we're in a precarious position with both Microsoft and NVIDIA currently testing. And see, this isn't strength. Strength is when you come and you kiss the 200s and you rocket off them. That's what happens in a strong market. NVIDIA has been hugging the 200s like a, like a sailor overboard clinging to a life preserver. And Microsoft has been doing it for much longer. So they're still there. All I can tell you is support until unless broken. But if they start to crack and they start to bring the rest of the fangs down for a run at their 200s, we could see this market really start to roll over pretty quickly. All right, I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.